how's it going? Welcome to the recap for New York session for Wednesday, the 16th of March, 2022. So 4-hour chart, it's pretty damn messy. Hopefully you guys have watched my recap for London, where I've kind of explained all of this price action in a fair amount of detail. Yes, we are bearish. However, because we're coming up off such significant higher time frame extreme demand, it really wouldn't surprise me if we start to see a much deeper higher time frame pullback. With that said, 4-hour chart is very, very messy, right? We're getting sandwiched essentially between the supply chain, which now looks like we're potentially trying to break out of. We still haven't fully made this zone fail just yet. Get rid of those orange lines. And then we also have this demand chain, right, starting to form, where we then had a bullish change of character here, then we had a bearish one, then we had a bullish one, and that's what I was trying to explain this morning. Yes, they are, valid shocks, but it's what do you do with that information, right? How relevant is it to you and your trading decisions? Well, when price is basically just moving sideways and sandwiched between these zones, they don't really mean much. It's irrelevant. We expect price to kind of be breaking these highs and lows. So I personally don't read too much into them, other than it's not the highest probability of trading conditions, and you kind of want to be sticking to shorts from sort of the extremity of this internal range from supply, and then looking for longs from near the bottom and trying your best to kind of stay out of the middle until we get some clearer higher time frame intentions. So 15-minute chart, we've been stuck in this much larger swing range, okay, between this high here, very, very poorly drawn line, but you can see the high right and the low, and we had basically a very corrective pullback, but with yesterday and today, we've basically taken a low retracing, taken the highs, taken the lows retracing, right? It's all very, very indecisive, range bound, and tricky to trade, or at least to hold on to trades for a significant amount of time or distance, because there is no clear high time frame intention. It's as simple as that, really. So when we broke up through London, I'll just zoom in a little bit, to this level of supply here. Really, this was the last level of unmitigated pivot supply in M15, because you can see, right, all of these levels had already been mitigated. So yes, of course, price can still come up and reject some orders within here or even within the wicks. But when you're talking about the actual true single candle unmitigated pivot supply, this is the last one. So once this failed, it was pretty likely that there wasn't going to be enough supply within here to contain price, then continue that move. Of course, that could happen, but generally what you're going to want to see is a clear bearish M15 chock. So price would come up here, and then you would see that change of character. That would then give you another fresh supply zone to then look for that move to continue down. But once we saw this, the M15 internal structure then stayed bullish, right, as we then broke out to the upside. Finally breaking above this high here, which we did actually have an indication during Asia that this was going to be sort of that weak, larger internal high, right? Because so this is where it gets a bit confusing with internal structure, right? Because obviously the way in which we map it and the way in which we look at chock, we're looking at the very, very small movements of price, okay? But obviously there's kind of another type of internal structure where you have sort of these larger swings, right, within the swing high and the swing low. We just need kind of a bit of a different name from them. So you kind of have to interpret these, I guess, in a way on their own. And we can see here, right, when we look at this swing of price, that when price came down and tried to take out that low, it failed to do so. So in theory, as we're starting to come back up, there's a reasonable assumption that this high could be weak, okay? So anyway, coming back to this point, right, because this is a bit more of a simple and clear point. Once we'd broken up through the supply, there was nothing in here that was really likely to be able to contain price and then continue that movement down. So it was pretty game on now that high was going to go. So then when we did break up above it, what time was this? Kind of just coming into sort of New York around midday. Obviously there was still this extreme supply here that was valid, and of course could contain a fair amount of orders. There's quite a big zone as we come into the EQ, right? A fair amount of people don't count a zone as fully mitigated until the EQ has been tapped into anyway. But generally I don't like it. So when we've already seen a tap into it and it's already caused this big move, I see that as the zone already being, it's pretty much tried to do its job, right? The majority of the orders would have been filled. The majority of the time, if price has to come all the way back up, it's likely that any reaction from here will just be short-lived. It's not going to be enough to cause another move that's going to go on to break swing structure on the balance of probabilities, okay? So the point I'm kind of trying to get here at is that there's some decent logic to be looking for longs from within these demand zones to potentially anticipate that the M15 is going to switch bullish at that point, okay? Kind of once we'd broken up, if I can get this box to work. Once we've broken up above this high in the supply zone, right? I didn't really see there being a lot of supply in the way to contain price and to push it back down, okay? So there was, especially again when we consider the higher time frames coming off that monthly, weekly and daily demand, with the potential that we could be seeing that much bigger pullback up into the premium of this range, you can start to get a little bit more aggressive with your longs with anticipation that we could be seeing that deeper pullback, right? But with all of that said, let's try and, as always, keep things simple, right? 4 hour and M15 are bearish. There is no denying. We are trading between this M15 swing high and this M15 swing low. We are pretty much in the extreme premium, as premium as it can get. We then had a bearish change of character on the M15 coming into New York, okay, because we had the pullback, and then when we took the high, this high here, where's the nearest internal low? It would be this low here, right? Because that's the last candle that failed to break the prior candle's high. So that becomes your bearish change of character. So at that point, as we were kind of really coming into the peak of New York, we had rejected this zone. Like I said, I didn't fully like it, but it's still there nonetheless. We'd come into the EQ, we'd had a bearish change of character. So for me, if I was trading New York today, my main focus would have been looking for shorts from here, right? That would be, for me, the highest probability trade. It's pro trend, it's in the extreme, it's in the premium. Essentially, we've swept these highs. It's led to a bearish change of character, decent momentum, right, with that V shape. This would be the level. Obviously, price absolutely smashed up through that, so there was no one-on-one confirmation entry within there, so that's fine, okay? Now, obviously, the trade that kind of played out that a few people caught was the long within here. And there, like I said, is logic behind this for the reasons I outlined, right? I did not like this extreme supply zone. I already seen that has done its job. Price has broken up. You can kind of see the decent bullish swings in price. Maybe trying to anticipate the 4 hours switching bullish, etc., etc. But the way I view any longs from within here is the same way I was talking about the longs from within here during London. It's simply just to play the pullback up into this level here to then anticipate that move. If you backtest the strategy or this way of trading over a large sample size of trades, you will find that will be the most probable scenario over a large sample size of trades. That is generally what will happen when you're trading against basically all time frames, trading against the M15 4-hour trend. It's against the internal trend, it's against the premium, etc., etc. Most times you'll be able to trade a small reaction and then potentially up into here, and then that's the high probability move. So longs within here are more than valid. You just want to manage your expectations of kind of what sort of trade that is, right? It's a little bit riskier. So if this hadn't played out and you had taken a loss, that would be why. It's for those reasons, it's a low probability trade in my opinion. It's not that it's not valid, but my question to any of you who took it would simply be, is it within your plan? Because if you say you're following the beginner trade plan, or you're only focusing on pro M15 trend trades, or maybe in your plan it says you can trade counter to the M15, but first you need a bullish M15 chart so that you're at least trading in line with the internal structure in M15. Right? So if you have that in your plan, then this would be an invalid trade. That would simply be my question to you, is try to be consistent with the rules that you have within your plan. If your plan is a little bit more loose like mine is, because mine is admittedly pretty loose when it comes to whether I can trade counter trend or not, for me it's quite a simple plan, and when it's within an M15 POI, if I get my M1 entry model, I can execute it, and I use discretion on whether or not I like that M15 POI and whether or not it's something I want to trade against. But for the majority of you, I would say you want to have those clear and strict rules of when you're going to trade counter trend. On the balance of probabilities, most times this isn't going to be the best scenario in which to do that, right? Hopefully I've kind of made clear as to why, but very simple terms, it's counter the M15, it's counter the 4 hour, it's counter the M15 internal structure, etc., etc. So just view it as a quick trade, a quick hedge to take into here to the short, okay? Obviously it worked out. There's a lot of rhetoric obviously ongoing on with negotiation talks between Ukrainian and Russian officials, etc., etc. But that's the way I view it anyway. So there is logic behind it. It was a sweep zone, it had inducement. But other than that, it was heavily counter trend and not a well priced area. So that's why if we look at the M1 kind of for the entry within here, there was a nice V-shaped reaction. All right, let's build the story a little bit from the M1 extreme. Okay, boom, that's a great tick in the box to be looking for that counter trend long, right, up into the short from the supply zone. We have the M1 chock, perfect. Okay, so nice V-shaped reaction, M1 chock. There's no flip within here, right? So we have M1 supply, but there is no reaction to it, right? Price just pushes straight up, okay? So there's no flip within there. So at that point, if you wanted to take the long, you would set your limit, right, on this extreme here, which we can see price pulls back, but doesn't mitigate it, so it continues up. Now at that point, it gives you a flip, okay? So there's a flip, whoops, flip that swept, okay? So we have the initial reaction in, price does not close above the reaction until all the way over here, okay? So at that point you have the flip. So where can you enter in the flip? Well, it's anywhere from the top of the reaction, if I can get the tool to work right, down to the bottom of the reaction. So anywhere within here, but obviously it's quite a large box, so we can refine it down to a single candle. Now, what I like about this flip is what did it do? It swept liquidity. All right, and what's even better of the way it sweeps is it sweeps a low that actually caused a high, right? Because we pull back, that then breaks the high, right? So that low has decent structural liquidity below it, and then price sweeps it. Okay, so that's a flip that swept liquidity. If you really like this level, that would be what would fit most people's plan, right? If you take the flip if it sweeps. But why does it lose? Well, one, it's counter trend, so they're gonna have a much lower strike rate. Two, at that point, we'd come up and we'd mitigated this supply range here, which yes, it is initially just on the M1, but if you're actually going to investigate what that level is on the M15, it's these buy to sell wicks. Okay, so you're trying to basically short after a pro trend supply mitigation, which also was a flip because it flipped this level here. Right, so price came in to demand, it reacted, fell to a higher high, and push down. We've come into demand. Yes, you can look for a quick hedge long, but typically when you want to do that, it's generally higher probability if you get in before supply has been mitigated, because you're just trying to play the pullback back up to supply. Of course, there's a potential it could go up to the higher one, but once price has already mitigated this and then it's coming back down to your entry, it's obviously lower probability because now you're trading against that pro-trend supply mitigation, right? So that for me is the logical reason as to why the flip failed. Of course, it then built inducement and it came into the extreme. So the extreme is also valid. Some of you will have it in your plan to always take the extreme. Some of you will have it in your plan to set orders on both. For me, if the flip swept liquidity and I wanted to take it, then I'd take the flip and I would play a reaction off the extreme, okay? So then what you'd be looking for is the M1 chock, which we then get, and we get a flip, but then price doesn't come back until all the way over here. But at that point, that's a far way away where we've had another... we got up to 10.15 now, whoops. Bear with, right, that would be then when that extreme supply fails, and then you can continue to follow the bullish order flow. And if anything, that trade makes a bit more sense because you're now trading in line with the bullish internal structure, because the break of that high is what? It's the M15 change of character, okay? So this is quite messy price action, so if you're a little bit lost, don't worry, watch it a few times. But yeah, so initially that long from here can make sense, but then once it's mitigated that supply and it's coming back down, it's obviously even riskier. It does play out from the extreme in this case. You could look to then play the confirmation entry from here. So you'd be looking for another M1 chock, which we get here, but then price obviously breaks off and carries away then as the news comes in. So this would be the flip you'd be looking at, which makes a bit more sense when it does come back down, because at that point you've then had that internal breaker structure in M15. The M15 structure is now bullish, and now you have a demand level to look for, and there's your extreme M1 flip within there, okay? Not necessarily saying this is a trade you should take, but there's a bit more, for me at least, there's a bit more logic behind it, because now at least you're trading in line with the internal structure being on your side. M15 supply has failed, right? A lot of momentum to the upside. There's a bit more behind this, nice inducement, etc., etc. Okay, cool. So that's kind of my view on New York. Hopefully that makes sense. Hopefully I haven't confused you guys a little bit. It's not the highest probability of price action whatsoever. Kind of, in my opinion, forcing longs. That's heavily counter trends. But the logic behind it is that really any of the clear supply zones here had all already failed, okay? So there's a decent chance we are going to break out to the upside, especially after that weekly, daily, and monthly demand mitigation, right? But yeah, I just kind of want to just explain my view, my opinion as to why, if that isn't in your plan, then try to be consistent with what is in your plan. Unless you have reasonably loose rules regarding counter trend trading, like I do, then that's absolutely fair enough. Okay. Cool. So yeah, I don't think there's too much else I really wanted to add to that, other than there is FOMC coming out in a couple of hours or so. So yeah, please manage your risk and exit any positions that you may be in near to current price action, because it's pretty likely we're going to see some hopefully quite volatile moves, so we can break out of this area of indecision and get some sort of clearer, higher time frame intentions for the remainder of the week, and hopefully we can get some nice clean price action to work with. So with that said, hope you guys have a good day, and I will see you in the next one. Cheers, guys.